Let's get started. Um, for those of you joining us today for the first time, welcome to Bogart Wealth. I'm Brian Windsor. I am a certified financial planner, a vice president financial advisor here in our headquarters in McLean, Virginia. If you are an existing client of Bogart Wealth, welcome back. Great to have you guys here. Today, we're going to spend about an hour focusing on tax optimization and tax planning. How can Bogart Wealth educate me on the decisions that I need to make when it comes to taxes? It's a hard subject. There's a lot of nuances towards it. And in fact, the decisions that we make today can have impacts to us over a very long period of time. We're going to spend time talking about taxes specifically. We're going to learn a little bit about rules, rates, all that fun stuff that keeps us up at night. And then we're going to actually talk about how do we use this information in practice to maybe see more successful, better financial planning results. I'll have the question and answer box opened for anyone that has any questions. I'll try to get to them towards the end of the presentation. And if you want a copy of the presentation, don't hesitate. We're happy to provide one for you. You can either email me directly at bwindsor@bogartwealth.com or just reach out to us generally. We're happy to send it to you. All right, well, let's get started. So for those that are new to learning more about Bogart Wealth, let me just spend a little bit of time to talk about who we are and what do we do. Bogart Wealth incorporates three key facets to building deeper financial plans for our clients. We're an investment advisory firm located in McLean, Virginia, and we focus on deep financial planning, investment management, tax planning, tax optimization. We're a relatively large independent advisory firm with about $2.4 billion in assets, and about 1.6 of that is actually managed by us. Over 1,200 households across the nation look to us as their primary financial advisors. Advisory firms like Bogart Wealth usually uses their own, that has a custodian to custody clients' assets at. Bogart Wealth, we use Charles Schwab. So our clients that have accounts with us, we coordinate with Schwab for that. One of the things that we as fiduciaries take very highly is that we're transparent. We don't get any incentives for doing anything else besides managing our clients' monies. So we're transparent in how we do all of our fees, no commissions or incentives for us. Let's talk a little about the team here. Just to give you more of an understanding of who these beautiful people are that you're looking at the screen here. Everything that Bogart Wealth does, we do in-house. So as a advisory service firm, everything we do, we're not asking other firms to help out with. Everything we do in-house. Our operations team actually sits right outside of me here in McLean. Our financial planning team sits below me on the fifth floor. And then our portfolio management team, led by Alex Spencer, our chief investment officer, also sits on the fifth floor here in McLean. Our advisory firm, our advisors at the firm, if you look at this, all the credentials that you would need to work with an advisory firm, the majority of us are all certified financial planners. You know, to me, that's the gold standard in the financial planning industry, to know that I'm working with somebody that's been through it, that knows what they're doing, and it can help me execute on a successful financial plan. Comprehensive planning with us doesn't just end or begin with tax planning or tax optimization. We're looking at a whole comprehensive look at how your situation is set up and who are those people that are going to be impacted by your plan. To start, we start with a financial plan. So in working with us as fiduciaries, we want to understand your whole situation. We want to know what's the data that goes into it, sort of that quantitative information, but also the qualitative side as well. Who are those people that are around you that are supported by the decisions that you make? How can estate planning factor into your plan? How can your cash flow, how does taxes factor into all of that? We really believe that as you're gravitating towards retirement, having a firm like Bogart Wealth that can look at all of these facets in a bigger picture can help you better. We're located in McLean, Virginia. That's where I sit currently right now today. That's where the majority of us work, headquarters here. But we also have offices down in Houston, Texas, and the Woodlands in Texas, which I know a lot of you are probably logging in from today, from the Texas area. Rangers or Astros? I would like to be curious to see where people are thinking about that right now. All right, before we jump into the actual meat and potatoes of the conversation, We're not tax advisors. So we are certified financial planners that are familiar with much of the current tax law. Now, truth be told, though, we do have a tax firm that we work in coordination with. And so as you'll see as we go through this, we can get into a lot of the details along with our tax team to help you out. But the firm itself, Bogart Wealth, we are actually not tax advisors per se. Myself, certified financial planner, I am not a CPA. If you have your own independent tax advisor, obviously contact them about your specific situation. Again, we're not tax advisors. The information here is as of October 1st, 2023, subject to legislative changes. It's not intended to provide legal or tax advice. Bogart Wealth got a new compliance person. If you're familiar with our webinars before, maybe not all these disclosures, but these disclaimers, as you can see, with having a new compliance person, there's certainly a lot more disclosures that come along with this. We can provide you a written disclosure of our brochure discussing anything about our advisory services shortly. All right, let's get into why you're here. And we're going to talk about 3 key pieces. I'm going to talk about mostly about tax strategies to consider on the back end of this, but I want to highlight the Secure Act 2.0 that was just recently passed. It's impacting a lot of what we're going to be talking about today. And we're going to be talking about how taxes are, unless Congress makes any changes, taxes are changing like just within the next few years. What do we need to be thinking about as this happens, and what should we be doing today about it? And then lastly, we're going to hit some of the big bullet points of what are the things that we can do that may or may not impact our plan. And more importantly, how can this Bogart Wealth team help us with that? Whether you're already an existing client, maybe there's some things that you need to talk to your existing advisor about, or if you're new to Bogart Wealth, don't hesitate. This is where we're here to help. All of our financial planning that we do is complimentary for us to show you that, yeah, we're a firm that you're destined to be with over a long time. Okay, so if you're familiar with it, Congress at the very end of last year passed the Secure Act 2.0. So this is in addition to the original Secure Act that they passed a few years ago. Really, what I'll just highlight this. If you want to get into a deep dive of the Secure Act 2.0, I would absolutely recommend you jumping into our webinar series. Misty Garza had an absolute fantastic Secure 2.0 webinar a few months ago. Highly encourage that. About 45 minutes, just really good information. But I'm going to hit you with the highlights of what that actually was. New rules for required minimum distributions. Every single year, it feels like they're kind of pushing those years out. I tell you, if you're born in 1951, you hit the lucky spot where it was 70.5, then it was 72, now it's 73. Those keep being pushed on. But actually, depending on your age, you might not actually have to worry about required distributions till you're 75. We'll touch base on that in a few moments. They lowered the penalties for required distributions. Before, if you did not take that required distribution, you had to pay a 50% penalty. Now, they lowered it a little bit, about 25%. But certainly, let's take those. Let's not forget that. Catch-up contributions have been indexed for inflation, except if you're a higher income earner making more than $145,000, those catch-up contributions now need to be made in an after-tax Roth account. That's starting next year. Again, many topics to consider here. Highly recommend Misty's webinar if you want to get more information about Secure 2.0. So let's talk about those required distributions and how they've changed. I mean, years and years ago, when I was doing financial plans for people, 10, 15 years ago, it was always, hey, 70.5. That's when you have these required distributions. Then it was pushed to 72 with the original Secure Act. Now it's 73 for those, though, that are born between 1951 and 1959. So if you fall in any of those dates, know that, hey, when you're 73 years of age, those pre-tax monies that you have in like your IRAs and your 401ks, 403bs, you have to start taking a minimum distribution out. And we'll actually see what that cadence looks like in the next few minutes. If you're kind of curious about like, well, how much do I have to take? We'll actually kind of give you an idea what that looks like. Born 1960 or later, you now have a year of waiting till 75. So that puts you in the driver's seat of a lot of things when it comes time for, if you're retired before then, and you don't take required distributions to 75. Specifically, and I know this wasn't designed for this conversation, but from a cash flow purpose, where should I be thinking about taking money from? from my portfolio if I don't have these required distributions till 73, 75. That's when I'm forced to take it out. Does it make sense to do it earlier? Or should I lean on other assets? This is where we're here to help. That's where that detailed financial planning that we're doing is going to be able to be helpful for you. All right, so what didn't they include? Well, a couple things that were always talked about. Were they going to get rid of those backdoor Roth contributions? You may have heard about those. We'll talk about that and have a few slides to discuss that. And then also the mega backdoors, if you're familiar with that within your workplace plans. There was years and years ago, if you remember, there used to be an amount that you could put in, or sorry, an income amount. If I make too much, I can't do these things. Well, they got rid of that back in like 2011, I believe. And a lot of people were thinking about, oh, Congress is going to put it back on. Congress is going to put it back on. And that hasn't happened yet. So let's keep taking advantage of that as long as it makes sense for our plan, as long as we can. One other thing that I think has been interesting on the personal side when I've been advising clients making these bigger decisions in their lives is that these qualified charitable distributions, right? If you're familiar with that, that's where you can actually move monies away from your IRA. And as long as it goes directly to a 501c3 charity, that is not added to your income. You don't get a deduction, but it's not added to your income. Those qualified charitable distributions, you can still do that on the original required distribution age of 70 and a half. So every plan is going to be different in how you structure this. Just note that if you are 70 and a half, you can start donating money directly from your IRA. Perfect Secure 2.0. Misty seminar is fantastic. All right, so we touched base on the Secure Act. A couple big points to bake out required distributions and how that's changing. Let's talk about what's happening unless Congress does something to make changes towards that. Given the climate, your guess is as good as mine if anything changes. But for now, here's what we know. The Tax Cuts and Jobs Act of 2017 is expiring at the end of 2025. So what does that mean to you? Well, what that means is we're going to go back to 2017 levels. So your standard deduction for most people being cut in half, you do get the personal exemption back. Cap on state and local tax SALT is going to disappear. But if you look to the right, just where these tax rates are now and in the future, most high income earners, or those that are in just any tax bracket for that matter, expect taxes to go up. I mean, that's just where we are right now, unless things change. So we're in the year 2023. Currently, we're shooting this webinar in October of 2023. We have this year, 2024 and 25, and that's it, right? As far as before we jump up. So certainly, nonetheless, if you're thinking about making some decisions when it comes to your tax planning, you got to think now's got to be the time that you got to do it. Things can change nonetheless, but this is what we know now. And we want to plan accordingly towards that. What hasn't changed, what's not going away, for instance, with these change in tax codes, and some of these things we're going to talk about today. How much can you contribute to an IRA? How you can roll over? Taking what's called net unrealized appreciation from any individual company stock that's built into your company plan. Cost basis rules as far as you being able to sell specific lots. We'll talk about that. And then also getting a stepped up in cost basis. So familiar with that is that if you pass away with money in your non-retirement account, then your heirs, those receiving it with those specific monies, will get a step up date of death valuation. That's not changing. So all that's still staying in place as far as what we know right now. So let's talk a little bit about what those contribution amounts are. So if we're thinking about, okay, how much can I put away into these types of vehicles? And is there a benefit from a tax perspective for me? For a lot of clients, we know this, but I certainly want to just circle back on this where, number one, anyone can put money into a traditional IRA as long as they have income. It just depends if you make too much, you might not be able to actually get a deduction off your taxes. As you can see on the bottom line, you can make a deductible traditional IRA contribution up to $6,500 if you're under the age of 50. If you're over the age of 50, they let you do another $1,000 more, but you got to fall under these income brackets. So if I'm married, which I am, and me and my spouse, our income is between less than 116,000, Okay, I can still put money into my traditional IRA and deduct that. Great. But if our income is above 136,000, these are these phase outs that you see on the screen, and we're above that, I can still put money in, just don't get a deduction for it. So I don't get a benefit on the tax perspective, but as we know, I get tax deferred growth. That compounding over a very long period of time can have a lot of benefits. Roth IRAs. Get this question a lot. How much can I put in and can I convert? Does it make sense? We're going to talk a little bit about how we can help with the conversion. But one of the most common misconceptions I see here on the ground floor working with clients like yourself is that most clients believe I make too much money, I cannot convert. There's no restrictions. There's no income limits. That was taken away years ago. Just means you're going to pay taxes in today's rates to do so. And if you're making a lot of money, that might be hard to do. But we'll have to wait and see if it makes sense for your plan specifically. But if you are in between under these income limits, a joint filer under 218 or a single filer under 138, you can put in 6,500 into a Roth. If you've never heard what a Roth is, hey, I can put money in after taxes to this vehicle. I don't get any tax deductions. I don't get any breaks right now. So my after-tax money's going in there. Monies are going to grow tax deferred though. But I mean, the real sweet spot with Roths is when I withdraw that money, as long as I'm 59 and a half, and as long as that has been in existence, the Roth for 5 years, guys, I can take all this money out without paying any taxes. So, I mean, just think about this, right? If I have, a 20, 30-year time period of allowing this money to grow and grow and grow, how that compounding works, and then I withdraw and it's all tax-free, not bad. Right. So as far as I could get, maybe I could get the tax break today by putting it in a traditional IRA. But the question is what's my income right now? What's the exact tax amount that I'm saving right now for paying taxes on my traditional IRA in the future? With my Roth, okay, I'm going to pay the taxes up front, use after-tax money, not get a tax deduction, but I'm going to have that money tax-free to myself in the future. Oh, by the way, just so you know, Roth monies do not have required distributions associated with them. So no one's going to be knocking at your door saying you got to take money out. That's yours and for how you want to do it. Might also have some benefits to your estate. And from an estate planning perspective, we're going to get into that in a few minutes. I'm going to talk about how assets pass through from a tax perspective. Okay. So let's talk about how we can get more into these tax-free sources, even if we have maybe higher elevated incomes than what we just talked about in those previous slides. Okay, backdoor Roth IRA contributions. One of my good friends is a orthopedic surgeon. He has a really good salary. Every amount of his retirement assets are in his workplace plan, but he makes a lot of money. He can't contribute more directly to a Roth IRA. But the trick is he actually can. And, anyone can for that matter, is that I can take money from my bank account, post-tax money, make a quick pit stop into a traditional IRA, make that what's called that non-deductible contribution. If you remember that slide we had earlier that showed that anyone can make an IRA contribution, they just can't deduct it, right? So you put that money in, I don't deduct it. Oh, and by the way, I can then immediately convert that to a Roth. So that's where you get kind of that backdoor conversation where I'm going to take a quick pit stop here and then it's going to go to a Roth. Caveat there is how the IRS looks at that. Just so you know, if you have other IRA monies, well, I had my rollover IRA and I had my traditional IRA, and now I'm going to set this other traditional IRA just to do this backdoor. It's not going to be fully tax-free because the IRS looks at what you have in all of your other IRAs, and they're going to look at that pro rata. So if I have like a large lump sum of money from a previous 401k, doing this backdoor Roth contribution may or may not make sense from a tax perspective. Again, consult your financial advisor. And if you don't have one, we're available. Let's see, IRAs, great. So that's on the personal side. On the IRAs and what you can put away, we'll talk about your workplace plan as well. How much you can put away yourself, $22,500 this year. If you're over the age of 50, that's $7,500. If you have a 403B starting in 2024, 25, I believe, the IRS is going to allow you to put a little bit more if you're around the ages of 60, 61, 62. Check out Misty's Secure 2.0 video for more on that. So the maximum amount that any individual between themselves and their company can put in is $66,000. If I'm over the age of 50 and I can do that catch-up contribution, then I can actually put a, 73,500 is the maximum that can go in there. Okay. Let's talk about some other quick factors from a tax perspective, and then I want to get into more of what I think is more of the exciting part is, all the strategies that you can be thinking about from a tax planning perspective. But keep in mind, lifetime exclusions, annual exclusions of selling your primary residence. If you lived in your property for 2 out of the last 5 years and you sell it, $250,000 of capital gains can be excluded from your income. And it's $500,000 if it's joint, meaning the spouse, as well. So if I have a house, I bought it for $600,000 and I'm selling it for $1 million between me and my wife, it's a $400,000 gain. We've lived there 2 of the last 5 years. Okay, well, looks like I'm not paying any taxes for that. So it's just the 2 of the last 5 years is something to note, especially if you had this property, you lived in it, and then maybe you've moved and you're still renting it out and you're thinking about selling it and it's getting to be that last 5 years. That might be something to be thinking about if you're interested in selling your property. Might be a good time to do it from a tax perspective, because if not, all this goes away and that's all capital gains. So tax avoidance perspective, you can sell it a little bit earlier. We mentioned cost basis rules real briefly. If you've never seen it before, in your non-retirement accounts, I can pick and choose which tax fund I'm going to sell. So if I have multiple purchases of, Google stock, for instance, or ExxonMobil stock, or, whatever stock, and I want to, generate and make a sale, I can pick and choose which specific lots that I want to sell, because they may or may not have as worse of a tax impact. So I can sort of cherry pick which ones that I want. You can also sell a security at a loss. We'll talk about that in a quick second. But if I sell something at a loss, I can then use that to offset other gains, or use it to offset income, or carry it forward for when I do need it. Okay, so let's talk quickly on taxes, just so we get a baseline for what we're actually paying right now. We'll talk Social Security tax, we'll talk Medicare taxes, and we'll talk about the Obamacare surcharge. So as you may know, everyone pays 6.2% up to income of $160,000 into Social Security. This number, 160, goes up every single year, right? So way that works is that within your wages, you'll be paying Social Security taxes up to that level. Expect next year for that to go up as well if they haven't already announced that yet. Medicare taxes, 1.5% on income up to $200,000, $250,000 if it's joint. If it's in excess of that $200,000, $250,000, still the 1.5 for the employer, is that employer has that additional surcharge of 0.9% on top of that, as you can see right here. And that's just an income of excess of that, not for the entire amount. The net investment income tax, if you've ever run into this, it's the lesser of your net investment income or the excess of your modified adjusted gross income over either $200,000 or $250,000. And that surcharge is 3.8% of, again, which one is ever less. So it just depends, if you are looking to make a sale of a large cap gain, and you have a lot of income this year, and you kind of think about, well, maybe next year is going to be a lower income, there might be some ways that you want to think about this, so not getting that additional surcharge on those monies. Again, that's where we come in to have that consultation with you. Quickly on tax rates, this is our tax table currently, and we mentioned that's going to change in the next few years. One of the things that I've noticed over the years, and you guys may have thought this originally, or maybe you still do to this day, but we're in a progressive tax system. It's not like every dollar is taxed at whatever rate or whatever income that you have. Income between up to $11,000, that's taxed at a 10% rate. But then income on top of that between $11,000 and $44,000, if you're a single filer, is at the 12% rate. And then the 22% tax bracket is between 44 and 95. So in this case, if this person, makes $96,000 a year, not everything's taxed at 24%. It's just that amount that's in excess. Again, that sort of progressive rate that we're in right now. Joint filers, you get a little bit more of a bandwidth as far as the increase in taxable income. Brackets are still the same. It's just the amount of income that you have. I always think it's interesting when I'm helping clients with planning and tax planning is, I mean, look at this, at least for right now, right? Is that our taxable income, anything up to 190 is at 22%. And then the next bracket's really large, up to 364, but that's only the 24% tax bracket. The real steep increase to be mindful of is that any income for this person above 364, that amount's taxed at 32%. So be mindful of, again, if I'm going to get more and more income, that's going to be taxed a lot more than if it's between 22 and 24. It's just a bigger jump. And that's where we, a lot of times, will help clients with looking at taking income to certain levels. Talk to your estate attorneys here about how this impacts your plan. But a lot of clients have these very expensive trusts, and they can make a lot of sense for a lot of people based off of, how they want their plan to set up in their family situation. Certainly things to be thinking about, like, I don't trust my daughter's new boyfriend. Like, I want to have those monies separate. So it's there. We get that. We see it. But we got to be thinking about actually what that is going to be doing from a tax standpoint once the money's in there. Again, trust can be written certain ways to have income paid out. But if income is going to be retained in this trust, this is a pretty steep bracket here, right? I mean, any income that this trust generates above 14K, 37%, that's like our top tax bracket. So edge caution and just think about when you're looking about setting up these nice fancy documents, is just understanding what this is going to do from a tax perspective. All right, we are going to talk kitty taxes, and we'll talk capital gains, and then we'll go into Medicare and then talk more of the good stuff. You have a kid under the age of 18, you can establish a uniform transfer to minor account. You may have heard about them, UTMA accounts. The way that those operate is if I have income, dividends, interest, gains, the first $1,250 that is generated from that is tax-free. So if I think about it, is that if I have, I want to set up an account for my child or my grandchild, and I don't necessarily want it to be for college, because those are like those 529 plans, and they usually have to be used for college or college-related expenses. But I just want money that it's going to help them out in the future, whether it's just estate planning for myself and gifting, or just helping them with a future expense. That dividend and interest up to $1,250, the first $1,250 is completely tax-free. After that, the next $1,250 is taxed at a kitty tax rate, which is 10%. So the first $2,500 of income is relatively low cost from a tax perspective. So again, family situation, and depending upon how you want to save for your kid, children, grandchildren, one of these types of accounts may or may not make sense for your plan. All right, other taxes that we have to be worried about, guys: dividends, capital gains. Yeah, as you'll see here, if I sell something at a long-term capital gain, which just means that if I held something for longer than 1 year, and I sell it, that's considered a long-term gain. If I buy something and sell it within the first 364 days, that's considered short-term gains, which that's just taxable at ordinary income. So you get a little bit more favorable rates for long-term cap gains and qualified dividends. So anything of income that I get that's below that 250,000 mark, if I'm a joint filer, or 200 if I'm single, that's at the 15%. Remember, we haven't gone over that 200, 250 Obamacare surtax, so I'm in that 15% range. But if I do go over that 250 to 553, again, that's still a 15% cap gains rate. But now if I have that Obamacare surtax, those long-term capital gains of qualified dividends are at 18.8%. And then the highest rate for long-term capital gains is 492 for single, 553 for joint. That's 20% cap gains rate. So a lot of times when we work with clients and we're thinking about doing some selling, we can actually have, I mentioned we are affiliated with a tax team. We can send the order to them to say, well, how much can this client generate in capital gains this year and still keep themselves within that 15% cap gains bracket. Busy slide here, busy slide here. Just quickly to note, your income is going to be it can impact your Medicare premiums. So if you are age 65 or older, or quite frankly, age 63 or older, something to be mindful of. The way that this works is that if I, based off my 2021 income, is impacting what my 2023 Medicare premiums are going to be. Just like what I do in 2023 is going to impact 2025. And as you can see, the bigger the income I got, the bigger the premiums I have. Usually they go up by about $100 or so as you get to these, larger income brackets. I always think it's important to ask your financial advisor, if you're working with somebody else, should I be thinking about making these tax changes? Like, again, Roth conversions, which we'll talk about in a second. If we do these Roth conversions, it's going to elevate my income. I'm going to be paying more in Medicare. How does it make sense? Have somebody that can work with you that has the tools sophisticated enough to make these decisions. They say, yes, you're going to pay more money in taxes, or sorry, pay more money in Medicare premiums, but in the long run, it's going to make sense for you. Or maybe it doesn't. Again, you want to have something that you can sit with that can help figure that all out for you. Okay. So this is, I think, why I think we're all here is just having an understanding of what are some of the things that I want to be considering, whether I'm working, I'm thinking about retiring, or I am in retirement and I'm thinking about, myself today, or even estate planning in the future. We're going to circle back to backdoor Roth IRAs again, Roth conversions, net unrealized appreciation, otherwise known as NUA. We talked a little cap gains. We'll talk donor advice funds as well. Okay. You're saving for retirement. You got a lot of us have our 401ks, 403bs. Why are we doing it? Typically, with the pre-tax monies, the traditional monies, I'm putting money away today and saving money on my taxes today. I'm lowering my income. And then in the future, when I take it out, I'll pay taxes. Okay, great. I need the money. I need the tax break now because I'm in a high income year. So I want to be able to contribute to that. But in the future, my expenses are going to be lower. I'm not going to be paying as much in taxes. It makes more sense for me to save in those regards. Roth IRAs, a little bit different. You can save in Roth IRAs, Roth 401ks. Also, one quick point to make as we're here, I get a question a lot. I make too much money to put my Roth 401k. That's not the case. You can make as much money as you want. There's no income limits for Roth 401ks. If I'm doing it for my employer, through my employer, it doesn't matter what my income is. It's only on the Roth IRAs that actually has those restrictions. But again, I don't get money off my taxes today. So I'm going to still pay income at all of my rates today. And if I'm in my high income years, that could be a lot. But I do get tax-free growth and I do get tax-free withdrawals. So time value, if I have time on my side, more and more growth, I'd rather have that in an account that's going to be tax-free in the future as opposed to cause taxes down the line. Roth IRAs, 401ks are tax-free. I mentioned earlier, but just to make note, they're not subject to required distributions. Usually, a while back, Roth 401ks were included towards that. Happy to see that Secure 2.0 changed that. So now Roth 401ks are not subject to those required distributions. I'm going to come back to the beneficiaries in a second when we talk more about the estate side of things. Roth conversions. So Roth conversions, if you're familiar with that, is you basically take pre-tax money, pick it up, move it to my Roth. Whatever I move over in that year, it's going to be taxable at ordinary income. Well, I just told you, if Congress doesn't make any changes, taxes are going up in a few years. And then ask yourself this, do I think taxes are going to go up even more in the future? Now, granted, when I work with clients, we make financial planning decisions based off of the information that we know today. But again, ask yourself, if you think that taxes are going to go up in the future, I may want to pay more in today's tax rates. If I think taxes are going to go down in the future, I might wait because I think I can actually pay less in taxes over a long period of time. Okay. We saw this slide earlier, the pit stop. I make a backdoor Roth IRA contribution, but you also have the mega backdoor Roth contribution that some employer plans allow. I know, just checking that we have a lot of ExxonMobil participants here. Within your Voya plan, you also have the ability. I'm going to put an after-tax one-time contribution. Keep in mind, we probably want to do that before the end of the year. So you're probably looking to figure that out, within the next few weeks. But I make an after-tax contribution into my traditional 401k. That's sort of my front door deposit. And then I get the information of what I can then move over, and then I make that a conversion into a Roth IRA or Roth 401k. And it's just a pit stop. I'm not investing it. I'm not getting growth. It's just a quick exchange where I'm basically, using what the IRS allows me to do by making this contribution, then moving it over. I mentioned our ExxonMobil participants. You're familiar. If you've seen this before, your Voya statement. One thing to note is that the Voya does a great job at detailing what you have in after-tax money. But beware, when you look at your contribution type, it's going to show you the amounts that you have in after taxes. This includes what you put in and also what you've gained. What you've actually put in to the plan is down here in the post 86 pre-87 contributions. So this individual put in what, 274,000, and now it's gained at 562. Now, in this case, if this person just kind of allows us to grow, this 274 that I just mentioned, it's growing, but the earnings on that are growing before taxes. If I can get this money out, this 274 out, and move it to a Roth, now all the earnings are growing tax-free. Not bad, right? I'd rather have something that's going to grow it completely tax-free withdrawals than keeping it in something that's going to grow on a pre-tax basis. So something to be mindful of. We have a backdoor Roth, mega backdoor Roth conversion video that Mike Camara recently did. Excellent advisor. I would certainly highlight and reach the website to look at that. We talked Roth conversions. We'll talk about it a little bit more. Usually, again, when I'm sitting with clients, again, I don't want to put everyone in a bucket, but a lot of times when we consider Roth conversions, we usually wait till after we're done working. Well, why? Because, Brian, I'm working. I'm making X amount of dollars. I'm in these higher tax brackets now. But when I retire and I'm not getting those higher wages anymore, depending upon which source of money I'm living off of, I might be able to really drive my tax rate low. If I'm like living off of cash or non-retirement monies, I might be able to convert a lot up to certain tax brackets. And if I can convert a lot, roughly speaking, maybe over time, that's actually going to be beneficial. The good news is we can help. I'm going to show you a quick example of what that looks like. Why do we consider these conversions? A lot of times when I'm sitting down with a client, and if couple of my clients are on this right now, that a lot of times we'll talk about two big factors that Roth conversions will make sense for most people. Number one, does it help your estate and how you want to bequeath assets? And then number two, does it save you money in taxes long term? Some of these on the slide here that are built out, if you think tax rates are going to go up, again, these are all ifs, but from today and what we know, we're going to be able to help you provide how it helps your estate and does it help you save money in taxes longer term. All right, so progressive tax brackets favor traditional 401ks. When you make a contribution to your 401k, that's off the highest income that you get, because why? I'm lowering my taxable income. If I'm doing withdrawals and in coordination with other withdrawals that I have, that's at an overall average tax rate of those numbers. Reasons to convert, those require distributions, right? So remember, I mentioned it used to be 70.5, then it was 72, now it's 73. Hey, for those born in 1961 or older, 75. Required distributions go up. If you guys don't know this, over time, the percentage that the IRS says that you have to take is going to go up and up and up. So the more I have in pre-tax monies, assuming that I can still grow these monies, the IRS is going to say, oh, that's great that you're getting growth from this, but we still need you to take more money than you did last time, more of a percentage. What does that do to your taxes? That's only going to elevate your taxes greater and greater. There's, a lot of times when we run these detailed financial planning analysis at Bogart Wealth, we can actually see what those estimates are. And clear as day, you can see exactly how that's going to grow over time. What can we do to get ahead of that? A lot of times it's to think about Roth conversions. Talk to you about how that grows over time. Look at this. I mean, this is on the x-axis here, you can see ages and you can see the amount that you have to take out and how it exponentially increases. Assuming you live over the age of 100. Maybe that's a good thing. I don't know. But what you can see is that the first time that you're taking your required distributions, let's just say it's 73, it's 3.8% of the value as of December 31st of the year before. So that's what it is. That's locked in. So whatever your value was in December 2022, if you had a required distribution, that's what you have to take out this year. And now whatever your account's valued at the end of this year is what it's going to be percentage-wise for next year. But it starts at 3.8, but then by the time, you're 80, it's 5, but then it goes up faster. By the time you're almost 85, it's over 6. By the time you're 90, it's almost 9% you have to take out of the accounts per year. Again, assuming you still get growth within the accounts, taking more money out, it's going to be larger in taxes. Well, one quick note, I just think it's funny. If you hit 120 years of age, you got to take 50% out. So that's a large number. Doing detailed planning. So if you're sitting down with us here at Bogart Wealth, and we're looking at your specific cash flow, your expenses, and how these required distributions are projected to come out. Quite frankly, we can see, do you have an excess of required distributions? Meaning, is the IRS telling you that you have to take more money out than you actually need for taxes? Sorry, for cash flow. So if that's the case, if you have to take more money out than what you actually need, why are you paying taxes on it? If I can look at that, if I can sit down with somebody, do detailed planning now and look, 20, 30 years down the road and see that there's an issue, I want to probably do something today about it. And that's where those Roth conversions come in. Decision tree, you can look at this. We can send this to you. I typically think the decision is between you and your advisor and the tax advisor as well. All right, so I'm going to talk about a couple cases that we look at that are relatively common, where we have a client retiring at the end of this year, and we're going to assume that they're going to live off their non-retirement money first. So this is where somebody can take living off their non-retirement monies, like their joint accounts or individual accounts, but I'm not touching my retirement. I'm just going to allow that to grow. If that happens, hey, in this individual, once they hit the year 2037, they got required distributions immediately. 15%, their marginal rate for the income they need is now projecting to go to 33%. So now they're in double the tax bracket that they were in, really just because of required distributions. I had a question, is traditional requirement distributions treated as taxable income in the year of distribution? So if I have a required distribution, is that treated as taxable income in the year I do it? Yes, because that is, you're taking the income in that calendar year, that'll be taxable to you at that time. Here's an expectation of working with us and what you see visually from an analysis on, number one, the estate, and does Roth conversions make sense? So a lot of times in my previous life, when I worked for another large broker dealer, we would show clients end of life monies. Hey, you got a successful plan. You're going to have all much money left over at the end of it. That's great. Feel good about yourself. And in this case, hey, this person's leaving $18 million of future dollars left over in the year, 2052 maybe. So great. But what that doesn't tell us is, you're leaving this money to charities or your children. Which are the types of assets that they're expecting to receive? Because when you look at the bottom here, taxable assets, tax deferred, tax-free assets, there's different rules that go along with this for those that are going to be receiving this money. So taxable assets, this $9 million, this person's looking to bequeath to their heirs. This is non-retirement monies. So what happens here, I mentioned it earlier, this is where they get that step up in cost basis. So let's just say that they paid originally $5 million for this. I paid $5 million for these taxable assets. Now it's worth 9.9. And the day before I die, for some reason, I'm going to sell it. You're going to pay capital gains on that. But let's just assume that now I pass, that basis of $5 million, that goes away because now it's date of death to my heirs. So now the next generation gets this 9.9 million with no cost basis. They can sell it basically for no taxes. Be mindful of, though, after that they receive it, dividends, interest, and future gains are going to be taxable to them. One quick note that I'm going to make as I go into the next two is that there are no withdrawal requirements of these monies, meaning there's no forced withdrawals of these monies. Now, Tax-deferred assets, tax-free assets. These are IRAs, assuming IRAs. Tax-deferred assets, these are your pre-tax monies. This individual is leaving 7.7 million. Well, that's great. However, the way that the Secure Act, the first one, changed required distributions going to heirs, used to get what's called the stretch provision, which means that if I pass away, okay, then it goes to my heirs. Then they just have to take required distributions over their lifetime. And if they're young, their amount they have to take out is what, maybe 1% or 2%? Like that's okay, that's nothing. But the way it is now, these tax deferred monies, you have 10 years to withdraw everything in full. So if we're thinking about this client's $18 million, but 7.7 is going to go to, say, kids, where are they going to be in their lives when they receive these monies? And if they have 10 years to withdraw it, what's that going to do to their taxes? Something to think about. One quick note, before I start talking about tax-free assets and Roth, tax-deferred assets. If you're charitably inclined, this may be a place that you want to leave money to, because I can leave some of these monies or whatever you want to a charitable organization, and they receive it. They don't pay any taxes. So if I'm thinking about where I want to leave money towards, if it's going to my kids, best places are taxable assets, tax-free assets, the Roth, which we'll talk about. But tax-deferred assets, yeah, I can give it to my kids, but they're going to pay ordinary income taxes. If I'm going to leave money to a charity, tax-deferred assets may be the best place for that reason. Now, tax-free assets, that's a Roth. This is those after-tax monies in a Roth that are then going to go past to your heirs. Now, what do we know about Roths? They're tax-free. But just like I talked about earlier, these IRAs have to be taken out within 10 years. So while you still have to have your heirs withdraw this in 10 years, it's all tax-free to them. So another way of could be looking at this, if your children don't need this or your heirs don't need this, you get an additional 10 years of tax-free growth associated with these monies, as opposed to these taxable assets are immediately taxable, dividends, interest after you pass away. So it's all about how you're thinking about your estate plan and how do Roth conversions impact this. So in this case, this client is just going to go what we call a bracket bump. So in those earlier years, I'm going to increase their tax bracket up to the 22% tax bracket, just that next rung up. And if we do that, number one, on the right-hand side, how much are we projecting them that they can convert? So our planning tools can say, okay, well, based off of if you're going to live off this cash flow from your non-retirement accounts, your tax rate's going to be this. If you're going to go up to 22%, then in 2024, the planning team says, hey, I think you could probably do about 152,000. And then the next year, 217. Again, this has to be personalized to you. But we can see, okay, if I'm now converting over the next many, many years until I hit required distribution years or Social Security, different years that may change your tax bracket, this individual may be able to convert up to 1.6. And if they do that, how is that impacting their plan? Number one, 18.4 million left over. I'm going to go back to what I just saw earlier, 18.4 million, 18.4. I'm not changing the amount of the estate. But what I am changing is how my assets are being left to my heirs. So now I'm leaving over $6 million in this example. So if I'm thinking next generation, thinking about, hey, I want to leave money to my children, but I also don't want to leave them a huge tax burden, maybe this makes sense. One thing I'll mention right here, how we help with our clients, especially if a lot of my existing clients are on here. We're not tax advisors, but we have a tax team that we work with exclusively that actually then takes your last year's tax return, takes exactly what we estimate your income to be this year to say, okay, well, if we are doing this 22% conversion, when we get into the weeds here, it's not 152 like your planning team assumed with the bigger picture projections. It's actually $157,433. Well, again, whatever it is. And then our team says, okay, if that's the case, you want to make this an estimated tax payment. So we're here to help you from a planning perspective, but then also execute it with getting help from our CPAs. If you want to learn more about that, don't hesitate to let me know. Okay, so that was the estate side, right? So that could be the impact that it has on the estate. That's great. What about me, Brian? Like, I'm already leaving my kids $18 million. I want to make sure that I'm seeing a benefit and is there. Well, number one, we convert more, you have less required distributions. That's it, right? Because I don't have a large IRA pre-tax account because I moved some over the years to my Roth. Roths do not have required distributions. So I'm going to pay more upfront. and not have as much required distributions in the future. So I'm going to pay more in taxes up front and less in the future. How does this shake out for me? This is where our planning tools can sit and help with you, where we can say, okay, if you look on the right-hand side, these are tax estimates based off of doing either the base, which is no conversion, or the bump, which is the conversion. So you can see here, this individual here, actually we'll see that over with today's tax rates, even with the bump that we're getting in the next few years, they will actually be net positive on taxes in the year 2043. Assuming they live to 90 and tax rates haven't changed, they'd pay an estimate of 3.5 million over their lifetime if they don't do any conversions. If they do conversions and they live to 90, 2.9. So again, possibly saving $600,000 of total taxes. Like, this is real money, guys. Actual money to the IRS by doing conversions up front. Again, this doesn't work for everybody. I've seen plans where I've told clients, no, don't do this. It doesn't make sense for your specific plan. But there are a lot of clients that it may make sense for. Again, you gotta have somebody that you can work with that can help break this out for you. Again, this is what we do. This is why we're here to help. More information, Roth conversion strategies we have on our other webinars. Tax loss harvesting, I mentioned it ago. I'll bring it up here again. I have something that is running a loss. Behavioral finance wise says that the average investor feels 2.5 times worse about a loss than they feel about a gain. So a lot of times it's really hard for us as money managers, if we consider like yourself, if you're self-directed, of actually selling something at a loss, because you're admitting to yourself that it wasn't the right decision. Things go up and down all the time. Not everyone's going to be perfect, but you may actually be able to use that loss to your advantage in non-retirement accounts. So not your IRAs, not your Roths, but your normal investment accounts. If I have something at a loss, I can sell it. This loss I can now use to either offset other gains in my portfolio. I can use it to write off on taxes up to $3,000 every single year, or I can carry forward to following years. I remember I had a client years and years ago that did something like this in 2008, 2009, when the bottom dropped out. They harvested losses, meaning they sold one investment and then they moved to something similar, not identical, because we'll talk about that wash sale in a second. So their positioning in the market really didn't change, but now they accepted that loss. Things came back. Yes, they had gains, but now they had losses that they can pick and choose when they want to use it. Something we do here at Bogart Wealth with a lot of our individual stock strategies account is periodically throughout the year seeking loss harvesting opportunities. Are increased Medicare premiums? Good question. Are increased Medicare premiums included in the lifetime Roth conversion analysis? Yeah, absolutely. It's just an additional expense we built into the financial plan to make sure that it's still worthwhile. Great question. It's got to be considered in that to let you, because that's an additional expense. I'm going to be paying more Medicare premiums for those, say, 7-8 years. Let me make sure that that's still worth it. Yeah, absolutely. The one part of the wash sale rule, if I sell something at a loss, I cannot buy it back within 30 days because it just gets rid of the, the IRS is like, okay, you're trying to be sneaky. I see what you're doing. You're just trying to get the loss. So you can use, okay, you're not going to do that. But the rule is you have to wait 30 days. So if I really like the security and I sell it at a loss, I can buy it back. I just have to do it in 31 days. Or I could buy something similar. So I can I could sell a S&P 500 index fund at a loss and buy a large blend mutual fund. So technically different, similar structure, but I can immediately not change my positioning in the markets, but now I have a loss that I can use in other respects of my portfolio. Carry forward losses, yep, carry forward them as long as you want. So if I have something at a loss, sell something, I don't have any gains, I can just keep, when I need it, I'll use it. Just make sure your CPA puts that on your tax form. Last couple slides here, charitable donations. We mentioned the qualified charitables earlier in the presentation. You can be 70.5 and donate money from your IRAs directly to your charity of choice. Where I see it for a lot of clients is when they are now required distribution age. So if you're 73, 75, and you're like, okay, maybe I don't need this for income, or I've done the Roth conversions. I still have some minimum distributions. I don't need it for income. Instead of writing that check to your charity of choice, have that sent directly from your IRA up to $100,000 each person, because you can do that up to $100,000 each individual can go directly to a 501c3. Now, we're going to talk donor advised funds in a quick second. You cannot put this money in a donor advised fund. So if I can put non-retirement monies in my donor advised fund and get a tax deduction. We'll discuss that in a second. But I cannot take these QCDs from my IRAs and move it to a donor advised fund. I don't get any tax deductions for doing this. It's just not added to ordinary income. So again, if I don't need the money and I'm charitably inclined and I'm 75, 76, maybe I'll just do that instead. But you could do a donor advised fund. The donor advised fund means that I have cash or securities. I don't want to sell it, right? So I know we have a lot of clients on here from different workplace plans, defense contractors, energy companies that have appreciated securities, whether it's from their stock option plans, whether it's from restricted stock units that they've received. And over time, from what they paid for it versus what it's actually marketed at now is a huge unrealized gain. Well, let's just say I sell that and give it to a charity. I'm paying taxes on by doing that. What if I just took the security and directly donated to a donor advised fund? The donor advised fund, think about this as like your own charitable foundation that you're setting up for yourself. They're low cost. They're very easy to do. We partner with Charles Schwab. They have one that you can set up. We can help you with that, where you put that appreciated security. I'm not selling it, but then what goes into it is the market value of the security, not my cost basis. That's not the deduction. I'm getting the market value deduction from that, assuming I'm itemizing. Again, not if you're doing a standard deduction, you can still do the donor advised fund, but you're not going to get the incentives from lowering that on your taxes. Once it's in the donor advised fund, you can invest it, you can grow it, or you can immediately put it out to charities whenever you feel like it's desirable to do so. You don't have to, again, but it can go directly to the charities when you want to. I have a question. Does Roth conversions make less sense after 65 due to Medicare and after RMD start? Actually, no. Again, from my experience, again, not putting everyone in the same bucket, the majority of clients that we help support here, you find that additional $100 or $200 between you and your spouse a month, or call it, $1,200 or $2,400 a year in extra expenses for those will be minimal compared to the overall tax savings and estate monies that you're leaving your heirs. But maybe not. That's why we need to run those plans to see, again, your specific situation, how that works. Donor advised funds. One thing that I think is nice about these donor advised funds is charitable legacies. Complete sidebar to this conversation on taxes. It's a lot easier to maintain from an estate perspective. What I mean by that is I might have fancy estate documents that say all these assets go to a trust, and then I want my will to say that it goes to all these charities. What if I want to change that? What if my charities that I support change? I then have to go to my estate attorney and have that all drafted up again. That's time, that's money. But if I name the charitable accounts as beneficiaries, I can change that charitable amount, so who that money goes to, at any time just by logging in a Schwab. It makes it a lot easier to make updates and changes for that legacy. All right, coming up to the end of it all. If we need to see how this impacts you, I've said it before, I'll say it again, this is where we shine with taking this detailed financial planning look, associating the investment strategy to meet those needs, but taking tax planning into corporation to see exactly how these benefits are working for you and not just the masses. So reach out to us for a one-on-one financial planning session. We'll be happy to work with you on that. We have an entire retirement readiness series that are on the site now, more coming, really to help our clients be well educated to make good informed decisions about themselves and those that they care about. I think that's it. Yep. So thanks for joining. I'll see here if there's any more questions. And I had a question earlier. Do cash bonuses count as ordinary income? Yes, they do. Find this presentation. Like to share with my wife. Yep, send me an email, bwindsor@bogartwealth.com. If you do that, I'm happy to send this to you. You should hear from a colleague of mine as well, just to survey this presentation, and they'll be able to send it to you at that time as well. But if you want it now to go over them with them, bwindsor@bogartwealth.com. I can send it out to you. All right, guys. Again, if this is your first time seeing us here at Bogart Wealth, thanks for joining. Great to meet you. I'm happy to have you here. And then take care, stay well, and we'll talk soon. Thanks.